Okay, that's a look at the pro picks that you came on with in January. Now let's take a look at your pro picks for today. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, let's get into these pro picks. And, I'm trying to string together a theme. All it is their commodity plays. And Rick, you were very thoughtful about who's listening to this podcast. So it offers a lot of diversity. There's a large cap in there. There's a financial. There's a bit more of a smaller play. Let's start with Sprott. Sprott is back in a major way. That's one of your picks. It's the highest since 2011. You said on a previous chart that, maybe some of the easy money has been made on a stock that ran up this much. I'm guessing you don't feel the same way about Sprott?
Well, first of all, I need to disclaim the fact that I'm the largest Sprott shareholder. So I'm really, truly talking my book here. But the thesis goes like this. Sprott's a brand name for precious metals, and I think we're in a precious metals bull market. Sprott's AUM has doubled in 2.5 years. Which means its management fees have more than doubled while its costs haven't doubled. It generates a lot of free cash. It's paid off all its debt. And the assets under management are growing fairly rapidly. I would suggest that investors, particularly Canadian investors, think about it in the following fashion. If they want to be in resources, they could buy one of Sprott's many products and pay Sprott a fee, or they could buy Sprott, own all of them at once, and get paid a dividend. I'll leave the arithmetic to you. Pay a fee, or get paid a dividend. My suspicion, this is not inside information, my suspicion is that AUM goes from 40-something million US to 100 million US in the next 3 or 4 years. And Sprott gets taken over by a Manulife, by a BlackRock, by a Credit Suisse. Somebody who decides that they've ignored natural resources for 40 years, needs a natural resource franchise, and decides that they don't have 10 years to build one, so they have to buy one.
I mean, you'd have to assume, that your thesis is right too on the cycle lasting, right? These players aren't going to come forward if gold all of a sudden isn't doing what gold's been doing.
If you don't believe that we're going to have, on the one hand, a precious metals bull market and later a broader natural resources bull market, none of my picks make any sense.
Okay, that's good disclosure. EMX Royalty, again, not really a household name, smaller market cap, sub $1 billion, 675 million, metal mining royalty. What do you like here? Again, a very parabolic chart this year.
EMX was selling at a huge discount to what it was worth, and that discount is being arbitraged away. The company has announced a merger with Elemental, a different royalty company, that merges the commercial acumen of the Elemental side of the access to London capital markets with the extraordinary exploration expertise of EMX. These companies generate as opposed to have to buy royalties. The icing on the cake, I would suggest, is twofold. One, EMX has a large royalty over the Timok magmatic complex in Serbia, where Zijin is now running 16 rigs on a discovery that they won't talk about. But you get together all you need to know from Landsat photos of 16 rigs running from a major mining company, and the fact that post-merger, the new financial services giant, Tether, is investing $100 million in the combined companies, saying that they will support both the exploration and the royalty acquisition activities of these two companies. This is easily the fastest growing junior royalty company on the planet, and one that has the unique competitive advantage of being able to generate their own royalties through third-party funded exploration, enjoying the explicit support of a brand new name in financial services, and one of the true giants in money management, Tether. access to capital and access to the technology-based investment pool that Tether enjoys gives, I would suggest, Elemental EMX a real advantage over their peers in the royalty and streaming, in the junior royalty and streaming space.
Tether, like the crypto Tether.
Yes, ma'am.
Yeah.
Yes,
I'm
ma'am.
just like putting it all together. Why are they involved in this?
The Tether's the biggest gold buyer on the planet right now.
Because it's backed.
Correct.
So that's why they need it.
And I have it on reasonably good authority. My former firm, now FCP Capital Partners, was the advisor for Tether in their original journey into Elemental. The Tether people have come to understand the gold story. They've become intrigued by the gold story. And they were looking for an intelligent way to enter the upstream gold space and decided that royalty and streaming, which is to say financial interests, were probably a better way to cut their teeth than operating interests.
Wow, worlds colliding, crypto and gold together. Okay, your last one. People have definitely heard about this one. So you've really dealt with the spectrum of people who want something speculative, something spicy, and this Exxon. But honestly, Exxon is obviously huge, but it's sort of underperformed. What's to get so excited about Exxon right now?
That it's underperformed. It's cheap. The big thinkers in the world, that noted energy physicist Greta Thunberg, Mark Carney, people like that, would suggest to you that oil has entered the era of the dodo. They're in fact saying that peak oil will occur in 2032. Amber, peak oil demand won't occur in my lifetime. I don't think it'll occur in your lifetime. And the net present value calculations that people are valuing oil and gas companies on suggest that the end of oil and gas free cash flow is 2032, which is ridiculous. I think that Exxon is selling for half net present value. It's the best capital allocator in the oil space. They've made a discovery in Guyana that's big enough to move the dial on Exxon. While the industry as a whole, worldwide, is underinvesting in sustaining capital to the extent of $2 billion a day, Exxon isn't merely making sustaining capital investments. It invested $60 billion buying Pioneer to double down. This is simply the lowest risk bet in the energy business. And the energy business, by energy I mean now conventional oil and gas, is the single cheapest aspect in natural resources. And Exxon is an absolute bellwether. In terms of capital allocation, it is easily the best major company performer over 20 and 30 years.
Why not pick a Canadian company, which you could argue is even cheaper?
Because they have less safety. Exxon is the largest, most muscular, and most well-run company in the world. And Exxon doesn't have to suffer under a Carney discount. The world itself is not saying, except for perhaps in photo ops, that all of their investment decisions are carbon-centric. You have countries around the world who understand that the road to economic prosperity is carbon-centric, whether they choose to admit it or not. And the political headwinds that the Canadian companies face from Ottawa is something that constrains the growth of Exxon much less.
There's been a lot of M&A and consolidation activity in the Canadian oil patch. It's all been pretty much made in Canada solutions, a Canadian producer taking over another. There's a hostile takeover right now taking place for MEG. I wonder, do you think we'll see foreign players come back to Canada rather than divest away from Canada as they have been?
I don't think so, because I think the political climate around the Foreign Investment Review Act is such that the Canadian producers will be protected by Ottawa. I think they need to be protected from Ottawa, but that's a different question. And I also think that there is sufficient capital and sufficient expertise in Canada that there is a lot of room left for horizontal consolidation within Canada without having to involve foreign players. The Canadian capital markets are not capital short. And the Canadian oil and gas industry, despite the fact that it's underperformed in equities markets, have performed extremely well corporately. These companies, which exhibited fairly challenged balance sheets 6 and 7 years ago, are swimming in cash, absolutely swimming in cash. And they have very, very deep human resources, very deep talent banks. I would suggest that the talent banks in Canadian companies relative to market cap substantially better than they are in the U.S. This is a rare set of virtues. And I would suspect that having the need to merge, the capital to merge, and the expertise to merge, that you're going to see a lot more made in Canada M&A activity in oil and gas.
Rick, it has been an absolute pleasure. We always learn something, actually more than something, when we speak to you. Thank you so much for joining us on the podcast.